Randy, I think this is a follow-up comment to what you had requested for me earlier that I'll get back to you on. But you said, I'm interested in the graph and any other Greeks. I'm not sure if you mean the Greek graph. You can see some of the Greeks in the graph that we showed a little while ago in relation to the Greeks themselves. And let's just go to an option chain. I'll just take APA, for example, Randy. And let me go to March 20th. Why not? And earlier, when we were looking at the custom spread tool, we went to the research and we went to the option research page. And this again shows you all of the data that we have for the option, including the different Greeks. You've got your gamma, theta, the expected rate of time decay per day, the vega, the effect against volatility, the gamma of the position, the change of the delta, and then of course your delta as well. But down below, we have the option graph, and as a default, we plot the option bid versus the implied volatility. And in this case, you can go back over time. Oh, I took a March. Oh yeah, so I'm sorry. You see the dates here. It goes all the way back to before 126. This is over the life of this particular option since it's been released. But I can compare this if I wanted to delta, say, versus implied volatility, or delta versus time value. So I can get two different indicators there to track sort of the delta over time versus implied volatility, or delta versus, delta's red, I'm sorry, implied volatility is blue in this case, or delta versus the option bid. And you see there's, depending on the price change, this isn't a great correlation, but depending on price change, that's why the delta is moving up and the implied volatility is coming down. This was on a call, so that probably meant the stock was going up at that time. So this is a quick way to see the history, of course, and you can lengthen or shorten the time frame of the chart that you want to see, and just use what's called the scrubber, of course, to highlight over it to see certain sections as well if you want a smaller duration or a larger duration as well. Depending... Yeah, we do have some education on the site, Randy, as well. I'm sure you've seen it back in the free webinars section. I believe it's under Options Concepts here on our webinars page. Okay, so this is an older one. I'm probably going to redo it soon. Greeks and why you may not need them. And in this webinar, I just point out that we review what all of the Greeks are, their definition, how one might use them. But I actually find myself personally that in, I don't know, 80%, now probably 75% of the strategies I trade, I'm not even looking at the Greeks, at delta, gamma, theta, vega, or rho, okay? Or anything else along those lines. So a lot of times I'm not even looking at implied volatility. I'm not saying they're not important. I'm just saying for structures, there's two things here. And I always like showing this. I think it's kind of neat. But if 50% of my portfolio, Randy, I mentioned, is in the conservative radioactive trading married put structures, where we're looking for positions that have a risk between, about 3.5% to 9%. Okay? Now, when I do webinars sometimes on covered calls, Randy, naked puts, collar spreads even, or the married puts, I talk about the structure that I want and the type of stocks that I want. What am I going to want for a naked put or a covered call? I'm going to want a stock that's in an uptrend that, yes, does offer a good premium, but also has good fundamentals and reflects good management, good earnings per share growth, mid to large cap stocks, good strong average stock volume, no earnings between now and expiration, and so forth. And what I typically find, Randy, is every time I run a search from scratch of just the 7 or 10 basic things I would look for in a covered call, naked put, diagonal spread, I'm sorry, scratch that last one, covered call, naked put, collar in a married put position. Let's say I even change it to match my needs. I just take a risk of 3.5 to 7.5%. What is there no filters for here? There's no filters for delta, probability, percent to double, time value, percentage time. There is, but there's not. I'll talk about that in just a moment. And, I'm going to leave the stock price at 200, but normally the first thing I do, Randy, on this search after that, changing that little risk level there, is I'll drop this down to my range of about $85, $90 per share for the underlying stock price. And then we hit submit. Okay, so here's my list of 15 stocks that match the other criteria I need, the risk level I want for the married put, the strikes not going more than 20% in the money, want some relative volatility, stock in an uptrend, good earnings per share growth, and we're using a specific stock list. Without using delta, without using implied volatility, without even considering gamma or theta in this situation, I can tell you that the delta is between 0.52 and 0.67, pretty restricted. I can tell you that the implied volatilities are probably between 0.25 to 0.45, maybe 0.47, depending if any of these have earnings come up. So that's pretty restrictive without using a restriction. The gammas are all probably around, the delta is probably around 0.09 to 0.07, maybe 0.06. Okay, so let's just see. I'm going to go to add remove columns. Oh, I can't add. Oh, I can. I'm sorry. Gamma, Vega, row. And, oh, I threw applied volatility in there as well. Okay. All right, so there we go. Let's go ahead and submit that. Close the window. So I selected all the Greeks to add in. There we go. Sorry. Close that down. All right, so what do we have there? Implied volatility, 0.45. I said 0.47, right? Oh, I was a little bit off. The implied volatility is from 0.215 to 0.45, so a little bit below, but everything else is 0.23, 0.35. Oh, I didn't add delta. I'm sorry. Look, there's the gamma I was talking about, between about 0.03 to 0.094 in a tight range. The theta, all about what we'd expect, 0.01, 0.03, and Vega is in its range, all very restrictive. And it's because all these things go hand in hand. So a customer can call me up and say, look, I want to trade bull put credit spreads, but I know that I only want to look for a delta. I was told to only look for delta on the short option between negative 0.2 to 0, negative 0.2 or lower as an absolute value. I'd say, okay, so you want a probability of 80% or higher. And they say, no, I want a delta. You can use the delta on the search. It's there. But everything works hand in hand. Those other calculations, probabilities, delta, time frame, when you're looking at the specific list of stocks and the type of stocks that you want, you're going to be filtering by delta, gamma, theta, Vega without even filtering by it, because everything kind of works hand in hand. Now, when you see an outlier, and do I see it out? There is this outlier here of, let's say, Vega of 0.07 for Aqua. Avaqua Water Technologies Corporation at 2363, and Neogenomics. And that does seem pretty low, but that's sort of expected in those cases. Now, if I suddenly see an implied volatility that's at 0.7 here, that would be an outlier, and that might mean that some big event's coming up. Okay, there. So here's my deltas. I mentioned 0.5 or so, 0.51, 0.52 to 0.64. I said, I believe, 0.51 or 0.52 to 0.65, and that's exactly where we are. Without even filtering by delta, I just know, you know what it's going to be based on, I know what it's likely to be based on your range in the money or out of the money. They all go hand in hand. So that webinar that I was talking about with the Greeks and why you may not need them is that I personally feel for a lot of strategies, they're not important. Okay? For covered calls, I think it's more important to look at the structure and the underlying stock. And when you look for a good quality stock that's performing well with the return that you want to avoid earnings, if you want to be in the money to look for a higher probability of being assigned, let's say of 65, 70%, your delta is probably going to be 0.65 to 0.70, okay? Because you're going to be slightly in the money looking at deltas higher than 0.5 in the hope to get assigned. If you wanted to be out of the money for appreciation, just try to collect a dividend-like income, your delta is going to be around 0.4 to 0.2 to still get a reasonable premium. You go to a delta of 0.01, you're going to be receiving a 0 bid and 1 cent ask because you're too far out of the money. Okay, and so that's what that webinar is kind of saying. Now, that being said, the Greeks delta, delta ratio, gamma, theta are very important to me. and implied volatility as well, as we showed a little bit earlier, very important to me when considering diagonal call spreads, diagonal put spreads, or the double diagonal we looked at a little bit earlier, that sort of earnings double diagonal on FSLR, which I'm not saying I'm going to do, and I don't advocate that particular type of strategy around earnings. Not to say I don't advocate the double diagonal around earnings where the short option expires before the earnings and the longs expire after. This particular one was where the short and the longs were both after the earnings event, and that's not a good idea because it has a capped upside, and you could lose with a big swing to the upside and a big swing to the downside. Not the proper structure you probably want going through earnings. All right. So I think they're important for some strategies. I actually don't use them at all, and probably, again, 65, 70, 75% of the strategies I trade, because I focus on probability and the risk level and the underlying security, knowing what my delta is likely to be on the 10, 15, 30 results that come up on my screen, as well as the implied volatility. I may look at them, and if I see an outlier, that may mean something I need to research a little bit more. Why is that one so much different than the others? Okay, I'm just going to go to the quotes page for the moment, then we're going to take a look at the option chain. This is for Fernando. Fernando's comments, I think he's asking, but is there a way to forecast direction on a stock reading open interest and option volume? Well, there are some thoughts on that in this case, and some investors try to look at things such as the put-call volume ratio and the put-call open interest ratio. And these have certain numbers that, when the put-call volume ratio is greater than 1, that's usually a bullish signal. I'm sorry. The put-call ratio is greater than 1.3, 1.4. That's usually a bullish indication in that case, because it's a bearish indication. It's contrarian. I always mess that up in my head. It's sort of contrarian because it means there's more puts than calls, so the market is projecting that there's going to be a decline. And then the put-call open interest ratio is about the same. If it's some level above 1.3, it means it's bearish. If it's below 0.80, it means it's bullish. I find this to be right about 50, 60% of the time. Okay, in that case, it's not a fail-safe. Now, a lot of times I have conversations with customers, and we'll take a look at Adobe, see if there's anything here. I should probably use a search for this. I'm going to look at the calls real quick. Is there anything that's a major outlier? There's one that's a little different. Okay, and there's, okay, these two here, look. And this is, oh, that doesn't count. Let's go further out. Let me see if we've got anything. Oh, we know the earnings are the 13th, 12th to 13th, so let's take a look at March 13th. Wow. There's like no open interest in those calls the day after earnings. What about the puts? Where's my open interest? There's not much there. Okay, everyone's trading shorter term, or maybe they're trading the week after. Let's take a look. Not by much more. Okay, but so here's an interesting thing. Here's where I was going with this in this case, Fernando. What do I mean by an outlier? Look at this 370 strike out of the money. There's 3,376 put contracts that were traded today at the 370 strike. And the open interest was only 592. You say, wow, that's 6 times. Today there was 6 times the total volume. Now, is that someone speculating that the stock is going to drop and they're buying put options? Or does that mean that someone's speculating they're moving up and these are selling put options? What's also interesting in this case is it's not the exact same number, but today there's also 2,500 volume at the 355. Does that tell me there's another person buying cheap out-of-the-money puts for the week after expiration, projecting Adobe is going to fall? Another person selling 2,000, 3,000 puts, speculating it's going to go up? Or is this somehow a linked position that could be a bull put credit spread, a bear put debit spread, some kind of obscure straddle or strangle, or they could even be ratio spreads where they were selling twice as many contracts here as they were potentially buying, and the remaining 1,000 or so contracts here are something else. I don't know. Okay? Maybe he's hedging against his long. You're right. So that's the other thing. He could have bought the 3,376 puts and then sold 2,500 to lower the cost. But if it falls down, he still has more puts at this strike than this. It could be a ratio. I don't know. Okay? So I've never seen anyone prove to me that you can, looking for the hot volume, the increased volume, where the volume is 5-6 times greater than the current open interest, means the stock is going up or down. Whether you see it in a call, is that safe to say the stock's up, or is it going down? Is that to say the stock's, they're buying, you see it on puts, does that mean the stock's going down? You don't know if you're selling or buying. And what I usually expect to see here, okay, so let's just take another number. 370 strike for March, 3,376 contracts. Go to April. Okay, nothing there. I go March 27th, sorry. Nothing there. I'm sorry, I'm doing this on the fly, I don't know, and I don't want to pull up the full chain. Nothing there. Let's go June. Okay, so I'm not seeing any outliers. What I'm looking for, Fernando, is sometimes when you see a large volume near term, you go out further term on the same day. And if I saw 3,500 or 3,200 volume on the 370 put strike out to January, then we know it's some form of diagonal spread, which is more neutral than projecting a bullish or bearish position. So that's some things you want to look at when you see that hot volume, when you see a high volume pop up. And of course, as Sam mentions, sorry, folks. As Sam mentioned here, we see these big jumps, but I took the calls out. So is there anything here with current volume? No. Okay, so for March 20th, there's nothing in the call side. So that's some kind of put spread, it looks like to me, in that case, okay? All right. So to answer your question, you might want to take a look at how people use that put-call open interest ratio and put-call volume ratio. But I've had a feeling that it's not been, it's right maybe 50-60% of the time. I don't use that as a projection of bullish or bearish. I have not seen it be that successful any more than more common criteria, okay?